All right, it's time for Narendra to come in. Narendra, thank you so much for joining us on the show. We have a great question from a 31-year-old professional who's written in our portfolio segment. Jaswinder Singh has written in from Pune, Narendra. He wants to build a corpus of 10 crore rupees for himself over the next 22 years and 1 crore rupees for his child's wedding over the next 25 years. I'm assuming or I'm hoping that, there's a corpus. That corpus includes the child's education or maybe some other, targets as well. He tells us his child is about 1 year old right now and he has an income of 65,000 rupees. There's EPF, PPF, a couple of term insurance policies, a money-back policy, and he says health insurance is covered by his company. He wants to know if it makes sense to buy a term insurance cover of 1 crore rupees. Well, first of all, your health insurance is inadequate. At 3 lakh rupees by your company, that's not enough. You need to buy a policy for yourself, especially, and for your family if you have a young child in the family now. So do that immediately. Narendra, if we look at the money he's contributing, which is 5,500 rupees every month into mutual funds, and his targets of 11 crore rupees, even the most aggressive equity assumption of maybe 17 or 18%, will that be able to help him achieve his goal? Because he seems like he might fall slightly short.
No, he'll be substantially short, because without your contribution, nothing will accumulate. So I think you need to really clean up all that you have done so far, which is discontinue. First, build the foundations, which is have the health insurance and the term cover. And after that, methodically exit all your, traditional policies and the ULIPs. And pool all that money, save more. And, at least getting started with 25,000 rupees a month by way of SIP into equity fund and then increasing it by 10% annually will get you closer to your goals, which is, to 10 crore or 11 crore in about 25 years' time.
But Narendra, let's take a look at his mutual fund investments. He told you 5,500 rupees a month he's putting in these funds. He has the HDFC tax saver, the Birla Sun Life tax relief, SBI Magnum tax gain. So there's 3 funds there. And he wants to invest more into mutual funds for his child's higher education. What amount should he be putting aside? So obviously there isn't a very clear plan here. Let's assume he discontinues his PPF and, repurposes that money. There's also that money back policy that I'm not very pleased with. If he repurposes all of that cash and invests some more of his savings, which of our portfolios would you ideally like him to use?
First and foremost, one should be targeting completely exhausting the 80C, entitlement. That is up to 1.5 lakh rupees. So he should sum total all his EPF contribution and deduct that money from his from 1.5 lakh rupee. And so the rest of the money must find its way into a tax saving fund. And he is holding, 1 or 2 good tax saving fund. But he should discontinue the HDFC tax saver or, even the Magnum tax gain. He should get into the more aggressive ones, which is, I would say, the Reliance tax saver or, Axis long-term savings fund, long-term equity fund, which is a tax saving fund. They will be, superior choice for given his time frame and given his goal. And of that apart, all his money without the fixed income allocation should find its way into our aggressive portfolio, because given his EPF contribution, which is mandatory, he can do without the fixed income allocation or fixed income fund in our aggressive portfolio.
All right, so our aggressive portfolio is on your screen right now. Narendra is saying that you have the EPF, treat that as your fixed income and use the aggressive portfolio for your equity investments. And see, the good thing about this portfolio is that we track it on this fund on this show on a regular basis. So if there needs to be any changes, we'll tell you about them. And of course, if you have any more questions, you can get back in touch with us. 41-year-old Pallavi has written in. She wants to create a corpus of 50 lakh rupees in the next 10 years. Now, she tells us she has 1 lakh rupees set aside that she'd like to invest, and she can put in an additional 10,000 rupees every month in equity. Narendra, she wants a portfolio that she can invest in. Now, she hasn't told us how much risk she's willing to take or what this money is for, but let's assume that since she has 10 years and since she's 41 years old, she's going to want to be slightly conservative. Would our stable growth portfolio be a good way to go?
Given the age and, even assuming that, one is little conservative, I would say our stable growth portfolio will be very useful. Because I don't think a stable growth portfolio, though it sounds very conservative, it is not a conservative portfolio. Your money will be 60-65% of your money, or sometimes more, will be in equity. And it is very easy to absorb the volatility of such a fund. And one important thing which she should keep in mind is even the lump sum which she plans to make should not be made, should not be a lump sum investment. You must spread that money over the next 6 to 12 months.
And Narendra, the stable growth portfolio is obviously a very tax-efficient portfolio. How long or how often should she be reviewing that investment?
I don't think that portfolio. If you have to review, then I think you should review it every 3 years. And reviewing that portfolio will not translate into taking action, because what I have seen is on a 3-year basis, even in a market which is very volatile, balanced fund tend to be tend to score over equity fund, and that's the kind of phase of market which I visualize even now.
All right, so this is what we've learned so far. If you already have an EPF deduction, which is your PF deduction from your salary, there's really no reason to get the PPF as well. You just get 2 identical investments. Like Narendra, they're saying if you have an aggressive goal, like the young gentleman in the show earlier, then you have to use equity, as much equity as possible. And of course, health insurance and life insurance are non-negotiable, especially if you have a family depending on you. You must absolutely do that. Now, as we know, we recently started a brand new segment called Beginner's Guide, and we talked about how to do your KYC, how to buy a mutual fund online. This week, we're going to talk about paying your bills, and I'll tell you why that's important, because every time you miss a bill and you pay that 100 rupee fine on paying, your bill late, that money compounds and that, eats out of your savings. So if you start an ECS payment online, it could save you a lot of money in the future. Krishna is going to stand by and tell us how. Krishna.
Thank you, Faye. Today we talk about ECS, or Electronic Clearing Service, something that takes away the pain of writing out checks, especially for those recurring payments again and again. It puts the cumbersome task of paying anything from your utility bills like mobile and electricity to even your SIPs and EMIs on autopilot. First up, you need to be registered for net banking with the bank of your choice. Believe you me when I say it's a total breeze, and more importantly, it will help you save precious time and energy. Once you have that, it's rather simple and straightforward. Just log into your account, once the page opens, go to My Billers and add a beneficiary. Choose an appropriate category and provide the necessary information about who you want to make your payments to. While doing all this, you will get an option to fix the amount of ECS. You enter the exact amount that you want paid out of your account on a regular basis. What's more, you can actually set ECS with a minimum amount due or even a maximum limit as well. For instance, if you set an ECS on your credit card bill with a maximum limit of 10,000 rupees and the amount due on your credit card is 8,000 rupees for the month, then an ECS of just 8,000 rupees will be swiped off your account. Keep in mind, an ECS debit mandate is just like a check issued by you. This means you need to ensure that there are enough funds in the account so that the ECS gets cleared. If you bounce an ECS, you will have to bear the same fines that you would have for a bounced check, and that could be as much as 750 rupees. Fingers crossed that never happens. And with that, it's back to you, Faye, in the studio.
All right, Krishna, it's always a pleasure. You're watching Investor's Guide in ET now. Thank you for staying with us. It's time for us to review the fund that we look at every week. This week, it's the Franklin India Bluechip Fund, another very large, very popular fund. Avan will give us the numbers on what the latest performance has been, and then we'll come back and talk about it. Avan.
Thanks, Faye. We look at one of the most popular equity funds this week, the Franklin India Bluechip Fund. With 6,479 crore rupees as assets under management, the fund has had an impressive track record since its launch in 1993. Let's take a look at its performance graph over the last 5 years. Now, the red line is the fund and the blue line is the benchmark, the BSE Sensex. The fund has been on top of the long-term chart among the large cap funds with a return of 23%, except for 2013, when the fund underperformed its benchmark with a return of 4%. It made a strong comeback the following year with a return of 37%. The fund's biggest strength is that it shows resilience in a market downturn. It has a stronger management team and an impressive investment style to its credit. With a major focus on large cap companies, the fund manager stands by his investments, even when it's out of favor, making it apt for long-term investors. So should you stay invested in this fund? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for that very interesting chart that you showed us there. Narendra, Franklin India Bluechip, 4 stars on value research, strong, solid performer. What has been your review of the performance of the last 1 year? 19% return. Is that impressive as far as you're concerned?
Its orientation, its style purity, focus on large caps and blue chips is something which is likable, and it is stuck to it. It is the first fund in India which defined itself that what it is going to emphasize in its portfolio, and it has stuck to it all these years. On some occasion, this fund might look like, is not doing just as well as many others, but on any 5-year basis, this fund is always in the top quartile. And so I would say that if you're looking for a high quality large cap fund, blue chip fund, this is the fund to go.
Well, Narendra, it's very interesting the way the fund manager manages this fund, where they have an entire team looking into quality of balance sheet and looking into, solid companies that sort of dominate the space that they're in. As an investor, if I invest in this fund, and you said over 5 years, it is a strong, solid fund, what sort of returns, expectations should I have? Should I be expecting it to stay on top of the chart year on year? How do I review this fund if it's in my portfolio?
Year-on-year expectation from any equity fund is unreasonable because, markets are very erratic. I think the reasonable thing to expect from this fund will be on any 3-year, on any 2-year basis. Of course, it has beaten its benchmark, which is Sensex, almost every year, except for, barring 1 or 2 years in its 20-year history. But I would say that on a 5-year basis, expect a, outperformance by a wide margin. That is what quality brings in.
All right, outperformance by a wide margin on this fund over 5 years, remember, not over the short term. Then finally, what is your rating of the blue chip fund?
I would say that, there are many other impressive funds in this category, so I would slot it at 4 star.
4 stars there for the fund on Investor's Guide. Let's move on to our hold or sell segment. 56-year-old Rajesh Rathore has written in. He sent us a list of the mutual funds he's been investing in from 2005, Narendra. So he's been in these funds for the last 10 years. He tells us he can afford to hold for at least another 6 years until his retirement. He hopes to have created a corpus of 1 crore rupees by then. He's currently investing 33,000 rupees a month towards his mutual fund and has a surplus of 15,000 rupees. We could go through this list one by one. There's a UTI Opportunities and IDFC Premier Equity, Narendra. I know you think these are both good funds. Would you recommend that he continues investing in them?
Yes, he should continue investing in them. And, both are funds which, given his time frame, should reward him, adequately.
Well, he's also concerned that since there's been a fund manager change on the IDFC fund, if he should be worried about it. And I know there are a lot of other viewers and investors like him who tend to worry whenever there's a change in the fund manager. For this particular fund, does that cause you any concern at all?
Yes, I'm quite concerned. But I don't think that warrants that, he should jump out of it. I think the portfolio is not going to change radically just because the fund manager has changed. Fund managers build or construct a portfolio and it has a lag effect. We have seen it on occasion. But, one should be watchful. It is definitely concerning because fund management is a task, or the role of a fund manager is very crucial in a fund. And here, this was a very unusually managed fund with a very unusual portfolio, and it succeeded. So the departure of a fund manager is definitely a matter of concern here. But I don't think that should warrant investors should be exiting this fund right away.
Don't exit the fund right away. And if you need someone to watch the fund for you, that's what we're here for. We'll keep a close eye on its performance. And if there's any reason for concern at all, you'll hear it first on this show. We'll tell you whether or not you should be concerned. For now, we're just watching the change. ICICI Prudential Value Discovery and ICICI Prudential Dynamic are the next on his list. 5,000 rupees each into these funds. They're both good funds, Narendra. Continue this investment?
Both these funds are good, but I really wonder that for 10-year time frame, given the discipline, there is a great deal of complementary position in both the funds. So I would say that if you're willing to take chance, maybe stop your dynamic fund and contribution to dynamic fund and go with a value discovery fund.
All right, so switch to the value discovery fund. He also has the quantum long-term equity, Narendra. And for someone with a 15-year horizon, it seems just about right for him. Should he continue that investment?
Yes, quantum long-term equity is impressive for its cost and for its very well-stated, way of conducting its investments or making its investments. But this fund, one thing which I dislike about this fund that it takes a cash position on occasion and it may not be right all the time. if you can stay put with that, then this is a good fund to have.
All right, so we keep an eye on it from a long-term point of view, but for now you seem fine. Mirae Asset Emerging Blue Chip, Narendra, and Mirae Asset India Opportunities. Continue with both of those investments?
Yes, both funds are doing, have been very impressive. They have been among the best performing fund in its respective category. And both funds have no complementary position. Yes, continue with both the funds.
And finally, the Franklin India High Growth Companies. He has 3,000 rupees per month going into this fund, which seems fine. It's not a very high exposure given the money he's investing. Continue that investment as well?
Yes, he should continue these investments as well. And the more, the extra 15,000 rupees which he plans to invest, he should be funding his, Mirae Asset Emerging Blue Chip Fund and Franklin India High Growth Companies Fund. Given his investment time frame, given the kind of spread he will get from all his holdings, it will be worthwhile to increase his allocation there.
All right, increase your allocation there. I'm going to put those two funds on your list one more time. Narendra is saying the 15,000 rupees that you have to spare right now would be well served invested in these two funds. We've got so many questions from you about insurance. We've asked Gajendra to come in and help us out. Our first question comes in from 44-year-old Srinivasan, writes in from Pune. He says he has a monthly income of 6.5 lakh rupees and his wife is a homemaker and he has an 8-year-old daughter. Considering this background, what would be a good term insurance policy and a cover and a medical insurance policy that he should get? Well, there's no doubt about the fact that you have to have both term and medical insurance. But Gajendra, could you help him narrow down the choices from the market?
You're already doing mutual funds, which is the right step. But obviously, insurance is much more important, to start with, because if the family is dependent on you, in which case it is presently, so you need to protect your family. So term insurance is the best option, and you need to at least have around 10 to 15 times as your annual income as the sum assured. So since your salary is around 6.5 lakhs, you can easily get a cover of rupees 1 crore today, a term insurance for another 20-25 years. I would recommend you to go for online term insurances, wherein you can buy directly from the company. Here you are bypassing the agents, and that is why you'll be saving around 40% cost per annum. So these are very, very cheap, and you can go through many options. For your age, at 44, for a 1 crore cover, you can get as low as around 26,000 to around 45,000. So there are many options available to you. Another thing is that you should review it every 5 years or so. As your income increases, as your responsibility increases, so should be your cover. So that was on the term insurance side. And with regard to the health insurance, definitely health insurance is also must for you for a family of 3. So you can buy a 10 lakh kind of a cover, because anything below that will be too less for the family. And again, for your age, per annum the premium would be somewhere close to around 20,000 rupees per annum. You can go with private insurance companies. They all offer floating insurance covers wherein the entire family is covered, and any one of you can utilize this 10 lakh amount per year, and it is reset every year. So you must go for these two covers as soon as possible and continue with your mutual fund investing the way you've been doing it.
We have a question from Binil from Dubai. He says he and his family are adequately covered overseas, but he's been thinking of buying a health insurance policy in India, mainly because, and rightfully so, he says that India is more affordable for healthcare than overseas, so it might make sense to come back to India to be treated if he ever needs to, which means he needs to buy health insurance. Now, Binil is a smart thinking NRI there. He tells us he's been speaking to an ICICI agent about a family critical health insurance plan, and he seems to be happy with everything that he's being offered. A 10 lakh rupee cover, he says, will cost his family about 42,000 rupees a year. He wants to know if the plan makes sense and if he should go ahead and buy it. What would you recommend he does, Gajendra?
So, though you mentioned that the family is covered, it's always a good option to cover for the health insurance options in India as well. Since I don't know your age and your family's age, it's difficult to give you exact idea on how much premium it would cost to you. But since you mentioned that for your ICICI policy, you will be paying roughly around 21,000. All my suggestion is that you should go for a family floater kind of a plan. ICICI's critical health insurance is a good option, but I would also recommend you to check out with other 3-4 insurance companies and then take a call accordingly, because sometimes you may get a better deal elsewhere with all the same conditions, terms and conditions being the same. So you can check out with companies like Max Bupa Health Insurance, Apollo Munich, or even Bajaj Health Insurance. So once you're able to compare all the 4, then you can decide which is right cover for you. and then you can go. With regard to the sum assured, I would say 10 lakh should be the minimum option for all the three members put together. So that, in that case, you are adequately covered. And you must also go for something like critical illness cover separately, because that is, in India, we are now seeing a lot of instances coming out due to our lifestyle. And that is a critical illness cover is mandatory. So I think once you have these two covers, I think you'll be in safe hands.
Last question comes in from Sohit. He tells us he's been investing in a ULIP in Max Life Insurance from 2008, and he wants to know whether or not he should continue with this investment. Now, Gajendra, he hasn't told us what ULIP he specifically bought, but can you help him make that decision?
First things first, my recommendation to you is that never mix your insurance and investments together. In the ULIP policy, you've been exactly doing that. So since 2008, you've been paying roughly 50,000 premium per annum, which over 7 years now works out to around 3.5 lakhs of premium. So I'm not sure how much that would be really working for you. Ideally, we would recommend that you should untangle the two. For insurance requirements, you should go for term insurance cover, and for your investment requirement, you should go for the proper investment products like maybe mutual funds or PPF or fixed deposits. When you mix the two, you end up paying in a lot of charges. So I'm not sure how much return you would have made in the last 7 years. But yes, my suggestion is that if you can exit right now without paying any surrender charges, you must exit whatever be the loss, and you should put into a good use, as in into good investment. And for insurance, only go for the term insurance, and that too online term insurances. That would be far cost effective for you.
All right, that's a wrap on this show. Remember, we talked about insurance, we talked about your PF and your EPF, and of course, your mutual funds. If there's anything in particular you'd like us to discuss on the show, feel free to write to us. Our email ID is at the bottom of your screen, and you can reach me personally on Twitter as well. Any suggestions you have are more than welcome. Tune in next week to catch the show. Thanks for watching.